Canada just shook the table. Ontario and Alberta have issued massive foreign bonds, completely locking out U.S. banks. Ontario's $2 billion deal, led by Barclays and Canadian banks, marks the first U.S.-free bond since 2011. This isn't just finance. It's a geopolitical statement. With U.S. tariffs squeezing Canada's steel and auto sectors, the response is loud and clear. Pivot away from Wall Street. Is this the dawn of a new financial era in North America? Let's break it down. Tariffs rattle Canada's financial engine. What started as tit-for-tat over tariffs is now rewiring the continent's financial system. In June 2025, Ontario issued a $2 billion Yankee bond, its first without a single U.S. bank since 2011. Instead, the province tapped Barclays, along with Canadian heavyweights BMO, CIBC, and Scotiabank. Was this about better rates? Not likely. It was a calculated move. Ontario's financial counterpunch to Trump-era tariffs on steel, tech, and auto components. Premier Doug Ford's government had already shifted public contracts to favor U.S. firms. Now, it's targeting the money pipeline. Context: Ontario is home to major Ford, GM, and Honda plants. So when Ontario flexes its financial muscle, the global auto industry pays attention. By sidelining U.S. banks, Ontario is signaling it's done playing ball on Trump's field. The province expects to borrow $60 billion this year, nearly a third of it from foreign markets. That's a huge volume of capital now flowing away from Wall Street. And make no mistake, this is more than fiscal strategy. It's a geopolitical play. Ontario is quietly steering its financial partnerships away from New York and toward London and Frankfurt. Alberta takes the off-ramp. Europe grabs the wheel. Ontario's not going alone. Back in March, Alberta made its own bold move, issuing 1.25 billion euros in bonds, without Bank of America, breaking a 6-year streak. Barclays, RBC, and TD led the deal. Officially, U.S. banks weren't excluded, but the signal was loud and clear, and it doesn't stop at bonds. Alberta is literally redirecting oil exports, reviving tanker routes to Asia and the Gulf of Mexico. Who's backing the financing? European insurers and banks. Even pension fund managers are shifting. Frankfurt's boardrooms are starting to host more Canadians than Washington's. Currency swaps, hedging, and capital flows are quietly drifting from Manhattan to Mayfair. For Alberta's transport and logistics sector, especially energy-linked heavy haulers, this pivot means rethinking financing, insurance, and supply contracts. If you run a trucking company in Edmonton, your next deal might be coming from Frankfurt, not Philly. Before we dive deeper, smash that like and subscribe button. It helps us reach more gearheads, policy wonks, and curious drivers like you. Buying Canadian, from steel boats to server farms. This isn't just about bonds or oil. Tariffs have redrawn Canada's debt map and are reshaping who wins government contracts. Ontario's new procurement rules now favor Canadian and allied vendors over U.S. competitors. If you're a software firm in Seattle or a steel supplier in Pittsburgh, you'll need to prove there's no local alternative or good luck bidding. One hospital, for example, selected a Swedish software firm over a U.S. one, citing currency risk and cost efficiency. That's no one-off. Multiply that across thousands of bids, and you get a wholesale shift from broadband to car bolts. For automakers, this means U.S. inputs are moving down the priority list, while Canadian suppliers move up. Supply chains were already strained. This adds another layer of recalibration. British Columbia remains partially aligned with U.S. financiers, but a bigger trend is clear. Canada is shifting lanes. Subtle cracks in the dollar's armor. Behind the scenes, Canada's financial system is quietly detaching from the U.S. dollar. In Vancouver, late-night commodity traders are reporting liquidity issues accessing USD, a faint echo of the 1998 Asian financial crisis. It's not panic, but the warning lights are blinking. Behind closed doors, Canadian financial institutions are no longer modeling risk based on the Fed's playbook. Instead, they're aligning with the European Central Bank's yield curve. That's not just a spreadsheet tweak. It's a directional shift in who sets the tone for capital strategy. Cross-border capital flows between Canada and the U.S. remain strong. Over $1 trillion parked south of the border, and $500 billion flowing north. But behind the scenes, many institutions are quietly installing safety nets. Hedges. A Boston-based fund recently added a hedge position against prolonged U.S. Canada trade instability, without even moving any assets. The play? Stay exposed, but brace for turbulence. We're already seeing this volatility on the ground. In Thunder Bay, a solar panel startup boomed after tariffs hit Chinese imports, only gets scorched by copper shipment delays out of Shanghai. A sharp reminder that in today's global supply chain jungle, local wins can still get tangled in overseas bottlenecks. Ontario's auto sector steers into the unknown. At the center of this financial storm sits Ontario's auto industry. The very place where Trump's tariffs hit hardest is now where Canada's financial counterpunch is landing with precision. Ford, GM, and Honda all operate massive plants in the province. For them, shifts in bond pricing, foreign capital access, and procurement policy aren't abstract. They directly affect production schedules, labor targets, and expansion plans. When Ontario borrows from Frankfurt instead of New York, it reorders or gets a seat at the investment table. But the gears aren't turning smoothly for everyone. European financiers, driven increasingly by ESG mandates, may hesitate to fund carbon-heavy projects. That spells trouble for oil-dependent provinces like Alberta, and even for hybrid vehicle programs still reliant on internal combustion components. For automakers, the new reality isn't just about labor or tax zones. It's about finding the right lender. And in this reshuffled deck, your financiers might weigh your emissions profile more than your profit margins. So where does that leave us? Let's step back and look at the bigger picture. Final verdict: a financial breakup with industrial fallout. Let's call it what it is. Canada didn't just skip Wall Street's table. It's setting its own. The headlines are about bond deals. But the real story? It's playing out beneath the surface, through logistics reroutes, procurement reforms, and capital redirection. This isn't just a Canada, U.S. spat. It's a prototype for how nations might respond when economic alliances grow strained, by quietly decoupling key systems, one contract at a time. So here's the verdict. This isn't a flash in the pan. It's a slow-burning shift that could reshape who builds what and where in North America. Now over to you. We wants to know, with Canada shifting financial loyalties eastward, will this impact what vehicles get built? And where? Are we witnessing the early stages of a broader economic uncoupling between Canada and the U.S.? Or is this just temporary political theater? Could this open the door for global players like China or the EU to gain leverage in North America's auto and energy sectors? Drop your thoughts in the comments. Whether you're wrenching in the garage or watching from a policy perch, we want to hear from you. And don't forget, subscribe.